This is going to be the only video that you need to watch about the different types of liquidity concepts. So by the end of the video, you know exactly what each of these liquidity concept means, and you can use it in the markets. So you don't even have to watch any other videos. Now I've mentored thousands of people from all around the world to achieve profitability using these concepts, so you can too. And they're making a lot of money doing it. So without further ado, let's get on with the video. So in this video, I'm going to teach you how to master liquidity concepts. First, what is liquidity? So, liquidity is an area or a level where business was previously conducted, or it's where lots of buy and sell orders are sitting. What's important to understand here is that liquidity is not just highs and lows. Liquidity is support levels, resistance levels, supply and demand zones, trend lines, equal highs, equal lows, significant highs and lows, basically anywhere where there is money sitting above or below. Now again, liquidity is also strategies. So breakout traders, for example, when a high gets taken, breakout traders buy. They're looking for price to continue. Where's the liquidity? Below that level. So again, there's a lot of manipulation that we need to be aware of to understand what liquidity is as a whole. Now, big players such as the banks and the institution, they need liquidity to enter or exit their trades. Of course, if there's no money sitting there, then the banks and the institutions can't execute their orders. They need a lot of money in a big pool for them to come and collect. Otherwise, price can't move, or they're going to lose a lot of money. So where do they find this liquidity? Around obvious levels. So like I've explained, highs, lows, support and resistance, these kind of zones have a lot of liquidity in that area. So if we can identify that, gives us a good idea of where price might be looking to go next. Again, this is an example of liquidity sitting above and below price. So we have a consolidation where price has this big push up, creating this trading range. We'll then consolidate throughout this area here. Now during this consolidation, people are trying to guess which way price is going to go. So like here, like we have marked out here in red, this is the stop loss of short traders. The stop losses of the long traders are down here. So what happens then? Well, if the stop losses are above this high and above all these individual high of the short traders, why has price gone and made a high here? What it's done is it's actually induced those traders. So price has made a high, inducing the traders and taking out the sellers. So now what do people do? Well, they shift their bias to go long. So when price pulls back in here, they're expecting price to react off this area here. Now we have market structure traders who saw a higher high, are trading within that internal range. We have the Fibonacci traders where price comes and actually makes a 61.8 retracement in this range here. They're expecting price to react from here and then go higher. You have your SMC or your supply and demand or your ICT guys that are waiting for a 1 minute break there or waiting for a reaction from supply, demand, or they've ordered base or they've got their order set at the demand zone. What does price do next? Instead of reacting and respecting that, it goes to take out the stop losses of the long traders, because keep in mind, everyone buying in this area here has their stop losses below each of these lows. So now they're all taken out. What does price then do? Price then creates this high and low, which is bearish range. What does everyone else do then? Well, they flip their bias. They're looking to sell in this range here, which is your Fibonacci retracement, which is your supply zone, which is your market structure, sufficient retracement, and where are their stop losses? Above this high. Boom. Are you starting to see that it's like a big game that is being played? If we can understand how this game is played, we can actually take trades that take this liquidity out. For example, price makes this high, come into this supply, react, we can then sell through that. And then when price makes this bearish range, everyone's looking for a sell here, we can find a reason to buy through that. Starting to see that we're playing the reverse game. If we're spotting where all the liquidity is, we're actually looking to go the opposite direction. Now, form of liquidity is equal highs and equal lows. So simply put, if price is tapped into a level 3 times, especially right at the same point, and also a low 3 times, this is creating your equal highs or your equal lows. Now what that means is above these highs, we have a lot of stop losses sitting there. Same thing here, above these lows, we have a lot of stop losses sitting there. So if price is going to come back into this zone and react or give us an entry model, then we can actually look to take price through that liquidity. Because again, if all that liquidity is going to be taken out, we often get an impulsive move here to actually shoot through that liquidity, and that could be a trade that we're looking to take. It's the same thing in a selling example. We'd look to actually sell through that because third touch of equal lows is very, very unlikely. And we'd be looking to really take advantage of all that liquidity, because not only is those equal highs and equal lows, but it's a big support and resistance zone. So again, when support is building up, we're looking to take a trade in the opposite direction and profit from all that liquidity that's sitting there. Here we have an ascending trend line and a descending trend line. So trend lines are another form of liquidity that we see in the markets. You can see where price comes into touches twice. This is where, again, we could draw this trend line across here. And then when we see price come up, we can see that, oh, we're coming into the trend line again. We actually tap into it this time and react higher. Now, this trend line has 3 touches. So on the 3rd touch, we're actually very unlikely to get a perfect reaction. A lot of the times we'll actually break through that. So what that means is we could actually trade the opposite direction and actually take a sell into the trend line liquidity where everyone else is buying. But if price is tapped into a trend line 3 times and made a high, we would then look for price to break that trend line. Not only that trend line, but also bearish structure, because again, when we're stepping up and making higher highs and higher lows, especially 3 times, we really would like to see that low taken, because it's very, very unlikely that we're going to see more structure respect and create a 4th high. So again, we're trading against the herd, find a reason to sell. We have entry models for this. We could actually sell through that trend line. Same thing in a descending example. You have 1, 2, and 3. And of course, when you have 3 structure pushes to the downside, making lower lows and lower highs, we will expect at some point that this area does not hold. You can see we have a supply zone which lines up with the trend line. And you can also see that there's a likelihood we get this to take out the trend line, the supply zone, and also the bearish structure where all the stop losses are sitting above. Here we have a swing high and a swing low. Now, when price creates a significant high, there's a lot of money sitting there. So as we can see, price previously had a high, higher high, higher low, and a higher high, and then actually broke structure to the downside. But this is such a significant high, which created such a big push in the market. So oftentimes there's a lot of money sitting, and there is a lot of money sitting above that swing high. So if price comes in and gives us a manipulation around this area here, then we could actually look to take that high out. Same thing with a swing low. We'd be looking to take that low out just with the amount of liquidity that is sitting below a significant low. Again, just think of liquidity as money. When you have a high or a low, so much money is sitting above or below that area that we can really take advantage of that. Number 4, supply and demand. So I've been talking about supply and demand throughout this video. We're just gonna get a little bit deeper into it now. So obviously supply, where sellers are waiting to go short. Again, supply is also a resistance zone. So that's something that we should really consider. So supply and demand is a form of support and resistance, because look at the price. Let's just look at the supply now. Price is coming into a supply, but support and resistance traders are seeing that price is coming into a resistance level. So supply traders are selling, support and resistance traders are selling. We also have relative equal highs, which means there is money sitting above here. And that is why often we see price burst through that. So that's something that we should really consider. And support is the same thing. So support and demand, same thing. Look, price makes a low, returns into that area, which is also a demand. Everyone looks for buys. What can we do? Let's look for a sell, take the liquidity out. Not only this support area in the demand zone, but also this significant low, which is what we just spoke about in the last slide. So that's very nice to see as well. Now, liquidity here means a pool of orders. So at a demand zone, you have a pool of orders sitting above, in that area. Supply, a pool of orders sitting there. Stop losses above the supply or above internal highs within the supply. For example, if we have a 15-minute bearish push here and price comes in, 1-minute bearish break, supply sellers are going to enter in the 1-minute range of the supply zone and their stop losses will be above. People that entered in this zone will have their stop losses above here. So that's why we can look for a move like this, which takes out the lower time frame sellers and also takes out the higher time frame or the supply zone sellers, which simply set a limit at the actual supply zone itself. Number 5 is a liquidity sweep. So the market jumps above or below a key level. So like a recent high or low, the market will jump above or below that. It does this to trigger the stop losses or grab the orders that are already sitting there. So when we know prices, for example, got this support zone, which is a liquidity area, which is a low. Here we have a high, higher low, higher high, higher low. We know that there's liquidity sitting below that low. Also, we have a liquidity zone across here and potentially equal lows on a lower time frame right there. So now we can see what does price do. Goes to take that liquidity out, which not only induces the buyers and takes them out of their trade, the buyers that are in the demand zone and also at the support level, but what it does is it makes everyone flip their bias. So then by flipping the bias, the more liquidity now sits above this high. And then what does price do? Reverses, but actually takes the high. So again, it's just confusing everyone. But what it's doing is it's grabbing the money because the money is below significant highs and lows, below support areas, below demand zones, below equal lows, relative equal lows. And so it just simply comes to collect that and continues in the direction that it always wanted to go. So that's very, very important to understand. Number 6 is an inducement. So an inducement is when the market tricks traders into entering early. So their stop losses add more liquidity for the big players. So in this case here, we have price make a high and a low. Now this is what we've gone through in the other examples already. But when we understand that there's a supply zone here, that there's your 61.8 retracement around this area, that when price reacts, what can we expect? Potentially an inducement of the high. So again, trick everyone into going short, then go high, inducing the previous high. That's exactly what we do. Then price just simply continues in the other direction. Now, what we can see in this example here is that there becomes 2 more demand zones in this area. Now, because price has now made a bullish push, especially because we have a large range from low to high, we have several zones within that which are internal structure. Price making higher highs and higher lows. So what we could actually expect if price is going to come down into this zone, which is zone 2, reacts, maybe gives a bullish break or a 5-minute candle with a big wick to the downside, anything that's trapping buyers into the market, we could take a sell through that liquidity to simply take out this zone and induce that low. So that's going to be the first point of confusion, and price more or less would be looking to do the same thing at each of these lower zones as well. So that's how we're kind of playing into inducements and using it to our advantage. So with inducements, price is going to create a small obvious setup, so like a mini support and resistance, a 1-minute bullish break structure. Everyone will jump in. They think that it's the real move. Price will then break that setup and hit their stop losses. So after clearing those stops, which is the inducement, the true move starts, or price will then move in the direction that it wants to move after that. 7 is a Fibonacci again, another thing that we've touched on here. So a tool that uses a percentage of retracement levels. So 38.2, 50, 61.8, 78.6. Now, traders are using it to guess where price might pull back before continuing. But the thing is, right, when we have market structure bullish, demand zone tapped into, which is also a 61.8 to 78.6 retracement. Again, Fibonacci traders are using that as their golden zones. When price is in that area, they see it as their hot zone. They're looking to take a buy. If price is bullish, of course, take a buy in that 61.8 retracement and see price higher. Does it happen? Sure. But when we're understanding and noticing that everyone's going long here, we have supply and demand traders, Fibonacci traders, SMC traders, market structure traders, support resistance traders, they're all going long. If we can see that, then it gives us a good opportunity to go short. Now we're just adding to that stack of liquidity that we're seeing in those areas. And guys, if you want to stop second guessing every entry that you make, finally hold trades with confidence, knowing why you're in and where you're going, and trade with a repeatable plan, not emotion or guesswork, then Currency Squad is what I've created for exactly that. Now, a free course is down below. It's in the first link in the description. Definitely go and check that out. Tons of value for you. Would love to work with you further. Guys, if you like this video, make sure to like, comment, and subscribe. And I'll see you on the next one.